You're listening to certified financial planner Doug Goldstein, host of the Goldstein on Gelt Show, www.goldsteinongelt.com.
Okay, I'm very excited to be talking with Spencer Jakab from the Wall Street Journal. You've probably seen the Heard on the Street column, which he edits, and he also just wrote a book called Heads I Win, Tails I Win, Why Smart Investors Fail and How to Tilt the Odds in Your Favor. Spencer, I really would like to tilt the odds in my favor, but people often tell me, there's nothing you can do because you can't control the market. And, we all know that no one can really beat it on a consistent basis. So can someone beat the market on a consistent basis?
Well, it depends how you look at it. I mean, let's think about it this way. There are dozens of books out there and thousands of people out there, literally, who are trying to give you an edge. And as you point out, they generally don't succeed, and people who try to get an edge don't succeed with sort of positive advice. This is what you need to do. This is what you need to buy. This is how you need to invest. This is how you need to think about the market. I think that at the margin, some of those can be, useful, but they're mildly useful, and they're only useful to people who are extremely disciplined and smart about employing them. On the other hand, there is a huge amount of low-hanging fruit out in the market because a typical investor is actually very bad. People don't realize, even about themselves, if they look at their own investment performance, how bad it is compared to just a completely passive strategy. When I say to people, if you're a typical investor and you follow this advice more or less, you could double or triple your nest egg over your saving lifetime. That sounds pretty good. But it's really the avoidance of errors and mistakes that are key to it.
Well, what are the low-hanging fruit? Does that mean there are some really good bargains out there?
It doesn't mean that, there could, of course, be, and I don't know what the bargains are. And by the way, no one else does either. Pundits are, generally useless or slightly more than useless in terms of following about specific advice. Do I buy Apple? Do I sell Apple? And whatnot. But the low-hanging fruit is very, very clearly there in terms of, it really boils down to two things. One is the things that investors do, the sort of zigging when they should zag, the way that people invest and the way that people psychologically and practically approach the market. And the other thing is the amount of money that people pay to be invested, some of the costs they're not even aware of that they incur upon themselves in taxes and transaction fees and things like that are absolutely unnecessary, like a true waste of money. And if you look at that, let's say, Doug, you were working in finance, and say you and your brother both inherit a large sum of money, right? And the person says, well, Doug, you obviously know what you're doing. You can take this money. You can't spend it, but you just invest it however you see fit, any mutual fund you want. And in 30 years, you can touch the money. And your brother can't touch it. He has to put it in the absolute lowest cost passive index fund, 60% stocks, 40% bonds, rebalanced, can't do anything. Your brother probably would have something like, after 30 years, and this is exaggerated because we're starting with a lump sum. This is not how most people invest. Something on the order of 4 to 5 times as much money as you, if you are merely typical, not bad, merely typical. And that's shocking, right?
It's funny that you're saying that. And of course, the numbers really do play out. We do see that when people work so hard to try and beat the market, they just don't. But you started your career as a pundit. You were in fact a stock analyst, right? You were one of these geniuses that people turn to, and you still are a genius that people turn to.
Right.
You were doing work. In other words, you really were adding value to the equation. It seems to me that the problem is people just don't know how to deal with all the information out there. And maybe the answer is if you don't know how to deal with it, so go just with a basic index fund. And of course, you have to choose which one, but that's a different question.
Yeah, I think for the vast majority of people, that passive approach is right. And yeah, I was an analyst, and now I write columns and edit columns in the Wall Street Journal that people take as investment advice. And the people here, obviously, they do a great job, and they're very smart. And you look on TV, they're the occasional sort of, bozo that you see on CNBC or Bloomberg TV or whatever. But the vast majority of people who are interviewed for their knowledge about some subject, let's say about the next iPhone or their investment prowess or whatever, what they're saying makes sense. The facts are correct. They've put a lot of effort into learning it. They have expensive educations. What they're saying is not wrong. They have a sophisticated understanding of it. What they don't do, and this is demonstrably true, is they don't add anything to security selection because what they're saying is sort of, is more or less reflected in the market. and they don't have a sense of what to do when. And if they did, they wouldn't be telling you. I mean, they would be, it's those who say don't know and those who know don't say. Those people are, but even the people who are giving you explicit advice, buy this now, sell that now, and then wind up giving you bad advice, they'll excuse away their mistakes. I think most people who are out there in the pundit business are not con men. A few are, but they sort of con themselves into thinking that they're better than they are. And some have decent track records, but it's very difficult to say, it's impossible to say if their track records are the result of luck or skill. But over a large group of people, you can see that pundits are just a coin flip. I mean, in studies have been done, you look at the proclamations of well-known pundits in the market, there's just no reason to follow them. And the fact that they've been right 3 times in a row, or they told you to buy Apple 10 years ago, doesn't matter. That doesn't have any bearing on the next thing they're going to tell you.
Right. A lot of these people could be sort of a black swan in the situation. We're talking with Spencer Jakab, who wrote the book Heads I Win, Tails I Win. He's talking to us from the newsroom at the Wall Street Journal, where he edits the Heard on the Street column. Spencer, I want to dive into this question that a lot of people have about index funds. And frankly, I'm involved in the index fund market too as an advisor, as a financial advisor. I work with people trying to help them to put together portfolios. One of the issues is today there are so many index funds, and lots of them have low cost, so it's not really an issue. And you can put your money in and not pay a lot. But the people themselves, of course, often end up messing themselves up. But even before they have the chance to mess up and, sell low and buy high, how would you suggest that someone choose, if he wants to make a portfolio of index funds, how do you choose what index to get into?
Well, I think that the broadest, most representative index in any category is generally the best choice. I mean, like you can buy the Vanguard Total Stock Market Index, which is or the equivalent given by other providers. I'm not really endorsing one product over the other. You want, you're buying an exchange-traded fund especially, and it applies less to a traditional mutual fund. You want the big liquid one, the one that turns over a lot, because your transaction costs getting into and out of them are the lowest. And you want that one that's most representative of the market. The S&P 500 is fine. That's about 86% of the value of U.S. stocks if you're talking about the U.S., but you can go even broader than that. A well-balanced portfolio should have those large capitalization stocks, but should have some stocks from outside the United States, should have some bonds, should have some real estate, should be, basically diversified. If you look at what a robo-advisor will do for you, for example, they'll choose 5 or 6 very low-cost index funds and then rebalance them. And that tends to dampen volatility. And volatility is what spooks people and makes people make bad decisions. And so dampening that volatility month to month, year to year is kind of has a positive side effect of making you less nervous and causing you to make fewer errors, cognitively.
I think what also kind of spooks people, and please don't take this the wrong way, but is the media. The media is out there with, the headlines. They got professional headline writers meant to either frighten people or excite them. What role do you think the media actually plays in normal people making really bad investment mistakes?
Well, guilty as charged. I mean, we're not out to spook people, but I mean, there's the saying that if it bleeds, it leads. You're not going to say nothing happened today or everything's fine or don't read this. You're going to tell people why something is important, why something is shocking, why bad news prevails over good news. If you look at, there was an interesting study done by a group called Bespoke Investment Group, where they looked at the Drudge headline indicator. Drudge, if there's a big headline, then they'll put it on top of the Drudge report. And when Drudge had a financial headline or didn't have a financial headline, i.e. when finance, and generally, that market went up 5 days in a row is not a headline. Market has gone down 5 days in a row. Dow has gone down 1,000 points, in the last 7 sessions or something like that. Then financial news is big. And there is a perfect inverse correlation between in terms of when the Drudge headline indicator was at its highest, when things were really scary, things were bad, that was the time to actually be investing. That preceded very good returns in the market. It's the scariest of times. It's the times when people are least likely to contribute to a stock fund, most likely, in fact, to be withdrawing money from a stock fund.
So they're doing exactly the opposite of what they should do based on the news, either frightening them or exciting them.
That's right. But the news is a reflection of, listen, I mean, I don't write a column anymore where I call people up and say, hey, tell me what happened in the market, but there's people here who do. And the news reflects what people in the market are saying, and they want to get quoted and they want to be dramatic too. And and we want people to read our stories. I mean,
I
we're not
wasn't blaming
manipulating
you.
people.
I'm not holding you responsible for this.
No, we're not manipulating people, but you're absolutely correct. I would say that the perfect time to, let's say, to up your allocation to stocks would be when not the Wall Street Journal, but when, let's say, your local paper, if, to the extent there are local papers anymore, has a headline that's about the stock market. That's a great day to buy. When basically even people who don't pay very much attention to the stock market are informed about how bad things just were. That's quite a good time. I'm not suggesting any timing strategy based on news headlines, but you're absolutely right that it does a disservice to people to sort of invest on the basis of what's in the headlines. And what I advise people to do is to the greatest extent possible, be mechanical, be kind of robotic about the way they invest, because that will insulate you from making any kind of emotional decision. And on the flip side as well, when something is very hot and you feel like a fool for not being in it or not chasing a trend, just ignore it. I mean, the 95% of people are going to be better served by just ignoring that stuff. It's hard to do, but
it is. It's so much easier said than done, because the reality is, you've been working and saving, and your $150,000 IRA all of a sudden drops to $85,000. You go, what was I doing here? And you want me to put more money into it? I think people get crazy. I actually saw a little while ago a study, and I just don't remember where it was. Maybe you've seen this, that they looked at people who invested with the benefit of the news and people who invested without the benefit of the news. And it turned out that those who weren't looking at the news actually did better over time. Even if it's not true,
there are many studies like that.
True.
There's a famous study that, for example, that looked anonymously at, I think, 33,000 brokerage accounts, discount brokerage accounts, and it adjusted for taxes and costs and everything. It just kind of looked at, who trades the most and who trades the least. And the frequency with which people trade led consistently to poorer returns. The people who got the best returns were those who traded the least. And there's been another study done by a professor at Columbia Business School showed that people who check their portfolio more often do worse. So even just looking at your portfolio, obviously every once in a while you have to do your taxes and things like that. But it's funny. My mom, I asked her a couple of years ago, like, who does your taxes? And she said, "Oh, I pay some guy." And her taxes are not very complicated. Like, "Mom, I'll do your taxes for you. Don't pay."
You're a good boy.
And then she told me, she told me, she was retired, but then she said, I got this letter. I owe some capital gains on. It was actually an Israeli company that she that was on NASDAQ that she had bought many years ago. I can remember back when you could first trade in online stocks. And I opened an account. I put the money in my checking account in this account, but I forgot I had it because I only bought 2 stocks. I didn't pay dividends, and I just eventually forgot that I had that thing, and they never sent me a letter. And then the Israeli company got bought. I can't remember what the company was, and she had some capital gain. It's like, okay, great. This is like the 90s that she had done this. What's the other company? Amazon.com. I mean, it wasn't a lot of money that she invested at the time, but I think it's worth as much as her apartment or something.
Nice,
I mean, it's
nice.
And you think it went up several thousand%, went down 90%, went up a ton, went down another almost 90%. All these crazy things, but she was oblivious to them because she, I don't recommend forgetting that you own something, but she was, insulated, because she just was forgetful and had forgotten that she'd opened this account. But of course, I don't recommend buying 2 stocks and doing that because your chances are not too great doing that. But the more that you can be like that and insulate yourself, the better off you are because you're giving yourself the gift of time and compounding. And the more you get into it, the worse you're going to do. Statistically, obviously, there are exceptions, but on average, it will erode your returns. There's no doubt.
Yeah, I think Eugene Fama, who won the Nobel Prize in economics, said that investing, it's like managing money is like soap. The more you handle it, the smaller it gets. Spencer, that study that you cited a minute ago about the 30,000 brokerage accounts was done by Terence O'Dean from the University of California.
Yes, it was. Yeah.
He was actually, I'm just going to mention this, then we got to wrap up. He was a guest on my show, the Goldstein on Gelt show. If anyone out there wants to listen to that interview, I guess you can see it on YouTube. Just go to Goldstein on Gelt and Terence O'Dean, and he talked about that study. But that's not the topic of our interview today. We've been talking with Spencer Jakab, who is the Heard on the Street column editor at the Wall Street Journal, and he's also the author of the book Heads I Win, Tails I Win, Why Smart Investors Fail, and How to Tilt the Odds in Your Favor. Spencer, in the last few seconds, just tell us, how can people follow you and follow your work?
I can be followed on Twitter, and I have an unusual spelling of my surname, so it's at Spencer Jakab, SpencerJakab. I can be followed at spencerjakab.com, same spelling, obviously. And you can read my articles. I still do write a couple of times a week at the Wall Street Journal. Look for my byline. And and then listen to things like this.
All right, and check out the book as well. We will put links to all of that at the show notes of today's show. Spencer Jakab, thanks so much for taking the time.
Thank you.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.